I think right now the concern that the market is absorbing is that inflation is not coming down as quickly as hoped. So yes, growth is fine, but we're not likely to get the boost in terms of lower rates that the markets had expected and really priced in for much of the first quarter. And I think that's causing some indigestion. So earnings are really going to be crucial here. How do earnings hold up? And particularly for those super large companies, not just in the US, but in other markets as well, because, we've noted that there's been a huge increase in market concentration in most of the major markets. What we call the granolas in Europe, for example, the 10 or 11 biggest companies also make up about a quarter of the value of the index of the 600 biggest companies. So again, what happens there, what happens to the dominant companies in Japan is going to be crucial. For now, they're doing very well because their margins are holding up extremely well. The market expects the 10 biggest companies in the US to actually boost their margins by nearly 400 basis points year over year. For the rest of the market, margins are likely to be flat or slightly down. If margins hold up, I think markets will be okay, but we're looking at relatively flat returns from here.
But Peter, is it really sector by sector? I know the luxury sector in Europe actually gave so much benefits, and now we're seeing even LVMH maybe beating expectations, but certainly on a downturn.
Yeah, because the expectations are built up to be so good for these dominant companies because they've had quarter after quarter of solid margins and decent revenue growth. And they've been relatively immune from rising interest rates because their balance sheets have been very strong. And the market has really bifurcated into really rewarding these defensive growth companies, whereas unprofitable, very long duration growth, which was previously outperforming in the years when interest rates were falling, has suffered a bit because of the rise in the cost of capital. For us, we still like these quality, if you like, defensive growth areas, including things like technology and healthcare. But we also like balancing it now with areas of deep value because there are areas of value industries which have been long neglected that actually are now posting decent cash flow. They're buying back shares, paying dividends, but they really have a significant value advantage.
But is that in the energy complex, or is
in
it
energy, in areas like banks, for example, in Europe, which were underperformers for a decade or more, but actually now are generating pretty decent earnings. They're buying back shares, they're paying dividends, but they're still very cheap. So having a barbell between the sort of quality growth, which is expensive, but is posting still very good fundamental compounding earnings, and some of this deep value, we think, in a relatively flatter market environment, is a good way to sort of hedge the risks.